The stock market is doing something remarkable right now. The S&P 500 continues to hit records high, delivering extraordinary returns over the last few years. And on the other hand, investors who stayed in the market have seen their portfolios grow significantly on a very positive side, and optimism has pushed the stock prices even higher. But whenever the market rises this fast, a question begins to spread across Wall Street and the Main Street alike. How long this will last, honestly. Many investors are becoming so nervous. Surveys also shows that a growing number of people believe a market downturn could happen within the next several months. They see high stock prices, economic uncertainty, and headlines warning about the bubble and crashes. It's possible. Now, then comes a statement from one of the most respected investors in the history, Warren Buffett. When Buffett warns about some investors may be gambling rather than investing, people pay attention to that. But what exactly does he mean? And more opportunity, should you sell your stock because of it? It's probably yes or no. So let me break this down step by step. First thing, why Warren Buffett warnings really matters. Warren Buffett isn't just another financial commentator. No, he has spent more than 6 decades building wealth through disciplined investing and has become one of the most successful investors who ever lived on the planet Earth. Now, that's why his comments carry so much weight. Recently, Buffett expressed concern about the behavior he sees in the market, not necessarily the market itself, but the action of many investors participating in it. His concern is that some people are no longer investing based on the business fundamentals. Instead, they are chasing quick profits, following social media trends, buying stocks because everyone else is buying, and assuming price will just keep continuing higher and higher. This behavior resembles gambling more than investing. That's what he says. Now, Buffett has always believed that investing should be based on understanding a company's values, earnings potential, and long-term prospects. Guidance reports. So when people ignore those factors, focus only on price movements, risk increases dramatically. And history shows that the period of speculation often ends painfully in a very bad sign. Now, are stocks actually overpriced? One of the reason investors are worried about is valuation. Many analysts argue that US stocks are trading at historically expensive level, and price to earnings ratios across the major indexes remain elevated compared to long-term averages. Now, when valuations are higher, future returns often becomes very lower. This doesn't guarantee crash, but it means investors may not enjoy the same explosive gains they experienced in the recent years. Now, think of it like buying a house. A fantastic house can still be bad investment if you pay too much price for it. The same principle applies to the stocks. Buffett has repeatedly emphasized that price matters. Even great companies can become risky investment when investors pay excessive premiums for a single stock. So, however, expensive markets can remain expensive for years and years. That's why valuation alone is not a reliable market timing tool. Just because stocks look expensive today doesn't mean they will fall tomorrow. No, that's not the story here. Now, the biggest mistakes investors they make, according to Buffett, whenever the fear enters the market, investors start asking just one question: should I sell every single thing now before the crash happens? Unfortunately, this mindset creates one of the biggest investing mistakes in the history of the Wall Street, trying to time the market on the point. So the problem is simple. To successfully time the market, you need to be correct twice. First, you must know exactly when to sell, then you must exactly know when to buy back in. Few people accomplish this consistently. Even professional funds managers struggle to predict short-term market movements. And many investors who sell during period of uncertainty end up watching the markets continue rising without them. Then after prices move higher, they buy back in at even more expensive levels. Now, Buffett has repeatedly warned against this behavior because it turns investing into emotional decision making. And emotional investing rarely produces great results if you really want to make money out of Wall Street. Now, what Warren Buffett actually recommends. Here's something many people absolutely miss. Despite warning about speculation, Warren Buffett has never suggested that average investors should constantly move in and out of the market. In fact, his advice has been remarkably consistent for years and years. But for most people, Warren Buffett recommends owning a low-cost S&P 500 index fund and holding it for the long term. This is what the basic was. But why? because broad market index allows investors to participate in the growth of hundreds of successful companies without even trying to predict individual stocks will win or not. And this strategy removes much of the emotional stress associated with investing. Well, instead of worrying about every headline, investors should focus on time in the market rather than timing the market. So according to Warren Buffett, patience is often a greater advantage than intelligence when it comes to building wealth on Wall Street. So when selling might actually make sense. Now, that doesn't mean nobody should ever sell the stock. There are situations where reducing exposure is reasonable. For example, if you need the money within the next few years, protecting your capital may be more important than pursuing additional growth. You got to remember this. Similarly, if your portfolio has become heavily concentrated in speculative stocks or sectors, or rebalancing could reduce risk. Now, selling can also make sense if your investment no longer match your financial goal or risk tolerance. So the key difference is motivation. Selling because your personal situation has changed is very different from selling because you're afraid of a headline, what comes on the Wall Street. Now, Warren Buffett's psychology encourages rational decision making based on the objectives and fundamentals, not fear. So the reason matters just as much as action itself. Now, bottom line, what history teaches. Market history provides an important lessons to everyone. Now, every major bull market has experienced corrections, crashes, and periods of uncertainty. On the other hand, investors faced fear during the dot-com crash and the financial crash of 2008 and the pandemic sell-off of 2020 and the numerous smaller corrections along the way. So the stock market continued moving higher over the long run, as everyone is enjoying. So those who stayed invested through volatility often achieve far better results than who repeatedly jumped in and out again and again. So this doesn't mean future performance is guaranteed, but it does remind us that temporary declines are a normal part of the investing game. Now, Warren Buffett has often said that if you cannot tolerate your stock falling 50%, you probably shouldn't own a stock in the first place. So volatility is the price investors pay for the longer term return. Overall, should you sell your stock or not? So let me answer this big question. Warren Buffett warns investors may be gambling right now, according to him, but for most long-term investors, the answer is probably no. Warren Buffett warning isn't about abandoning the stock market. It's about avoiding speculative behavior. He's calculating investors against chasing hype, ignoring valuation, and tearing the market into casino. So if you're investing in quality business, maintaining diversification, focusing on the long-term goals, Warren Buffett's message isn't necessarily a reason to panic. He's only trying to tell you one simple message. Instead, it's to remind just to stay disciplined. The future of the market is uncertain. It always has been. Nobody knows whether stock will rise, fall, or move sideways over the next few months. But history suggests that investors who remain patient, avoid emotional decision, and stick to a sound strategy are often rewarded over time. So rather than asking, should I sell everything in my portfolio, a better question might be for you, am I investing based on a long-term plan or not? Or am I simply reacting to the fear? Because according to the Warren Buffett, that difference can determine whether you're investing or gambling. If you enjoyed this video, don't forget to like, subscribe, and turn on your notification for more investment